Welcome back to the deep dive. Today we're doing something a bit different. Not a hot new launch, but more of a post-mortem, really. We're digging into the Freysa token, FAI, on the Base blockchain.
Yeah, and the reason we're looking at this is because the price action has been, well, disastrous.
Absolutely. Our mission here is to try and decode this just massive price collapse. I mean, you look at the chart and it's pretty shocking. We're talking about an asset that's down 93% from its peak back in early 2025. 93%?
hmm
That's not just, a bad week in the market. That feels like something fundamental broke.
Exactly. And that's what we need to figure out for you, the listener. We're going to put on our forensic economist hats today. We need to look at why that chart looks the way it does, what's the community feeling, is the code okay, and critically, what part did the team play in this consistent downward slide?
Okay, so the central question really is, why does it keep going down? Is there any floor?
Well, let's lay out the raw numbers first. It hit an all-time high, 0 or 8 cents back in January 2025.
8 cents. Okay.
And now, November 2025, we're looking at roughly $0.0054. So yeah, just over half a cent.
Wow.
That 93% drop, our research points very clearly towards fundamental design flaws. It's about the economics, the incentives, and these kind of unsustainable hype cycles it relied on.
It sounds like it was maybe built to fail in a way.
In many ways, yes. The seeds of this decline seem to have been sown right from the beginning. But let's start at the start. We need to understand the initial boom to really get the bust.
Right, because it wasn't always like this. It had an absolutely explosive beginning, didn't it?
Oh, incredibly explosive.
So Freysa launched the FAI token, when was it? November 2024?
That's right, November 2024. And the launch price was minuscule, like 0.001267, a tiny, tiny fraction of a cent.
So if you got in really early.
You saw some absolutely mind-boggling gains. That initial momentum was huge. It definitely caught the zeitgeist. That whole AI narrative was flying high then.
And that momentum carried it all the way up to that 8-cent peak on January 6th, 2025.
Yep. And that's a gain of over 6,300 times the launch price. 6,300x.
Insane numbers.
Truly life-changing for some early people. And that initial 6-week run, it pulled in a lot of attention, a lot of capital. It really cemented this idea for a while that FAI was, maybe a serious project.
But you mentioned hype cycles. What was actually driving that price?
Yeah, okay, this is probably the most critical piece of the puzzle. The price action is almost entirely tied to what the sources call the act-based engagement pattern.
Act-based engagement. What does that mean in practice?
It means the token's value is directly linked to these game cycles. They call them acts. In each act, users basically trying to trick or convince the Freysa AI agent into releasing a big prize pool.
Ah, okay, so it's like a competition, a game.
Exactly, like a
There.
time-limited game. And the price spikes when an act is running because people need the token to participate, or they speculate on the excitement.
So Act 1 was November 2024, coinciding with the launch.
Right. That drove the initial massive adoption, the hype, and ultimately that 8-cent all-time high in early January.
And then what happened?
Well, Act 1 ended, someone won the prize pool,
Yeah.
and predictably, interest just plummeted. The game was over for the time being.
Okay, so the team tried to restart the engine?
They did. They launched Act 2 in March 2025, and it did generate another wave of interest, another price pump.
But I sense a but coming.
A big but. Act 2 peaked at only 0.031 CT, 3 cents and a bit.
Okay, so less than half the first peak.
Exactly. Less than half. That's a huge warning sign right there. It shows this really clear, really rapid pattern of diminishing returns. The novelty was wearing off incredibly fast.
People weren't as excited the second time around.
Right. The game was maybe less novel, maybe harder, maybe people were just realizing it was temporary. Whatever the reason, the market response was significantly weaker.
And this is key to understanding why it keeps falling, isn't it? What happens between these acts?
Total collapse of demand. That's what the data shows. When there's no active game, no prize pool to chase, user engagement just falls off a cliff.
Because there's no other reason to hold or use the token.
Precisely. The community interest just evaporates because the token lacks any real persistent utility outside of playing this temporary game.
It's like you said, a viral mobile game, huge launch, everyone plays it for a week.
And then they move on, unless there's constantly new, engaging stuff being added.
Yeah.
With FAI, the new stuff was just another act months later, and it wasn't enough.
So after that second lower peak in March 2025, What did the chart do?
It entered this sustained grinding downtrend, just step after step lower.
Wow.
Where we are now, around half a cent, that's a 78.6% drop just from the January peak, let alone the launch price games.
And the recent performance?
It's just grim. You see these predictable, quite steep monthly drops, sometimes 8%, sometimes, closer to 50% in a single month.
Ouch.
Yeah. One analysis pointed out a 33.7% drop in just the 30 days leading up to late October 2025. It's just relentless selling.
So the market isn't even trying to find a bottom, it sounds like. It's just constantly repricing lower.
That's exactly what negative price discovery means in this context. The market consensus is that the token is fundamentally worth less today than it was yesterday, and it will likely be worth less again tomorrow.
So to sum up the price story, it's not a correction, it's not a dip, it's a structural cycle of boom and bust, driven by these temporary gains with consistent value destruction in between.
Perfectly put.
Yeah.
The booms get smaller, the busts get longer, the market learned the pattern. Get in for the act to get out immediately after.
Okay, so when you see a collapse like this, 93%, the first question many people ask, especially in crypto, is, was there a hack? Was the contract exploited? A rug pull?
Absolutely. You have to rule that out first. We looked into the smart contract integrity very closely.
And the verdict?
Surprisingly, perhaps, given the price action, the contract is clean.
Really?
Yeah. The FAI token uses a standard OpenZeppelin ERC20 implementation. It's deployed on the base blockchain.
Okay, OpenZeppelin, that's like the industry standard, right? Battle-tested code.
Exactly. It means they didn't try to reinvent the wheel with some custom, potentially buggy token code.
Yeah.
They used the gold standard libraries that secure billions of dollars across DeFi.
So no security holes.
Our analysis found no contract vulnerabilities, no reentrancy issues, no math errors like integer overflows, no backdoors and access control. They use modern libraries, OpenZeppelin v5.1.0. Technically speaking, the token contract itself is sound.
Wow. Okay, so the code is fine, but the token's value evaporated. That feels strange.
It does, but it's a really crucial lesson. Technical security does not equal economic viability.
Right.
The contract being clean just tells us the collapse wasn't caused by a direct hack or exploit draining the funds technically.
So the problem must lie somewhere else.
It has to. And all the evidence points towards the economic structure, the tokenomics, the incentive design. That's where the failure is. The how was built okay, but the why anyone should hold this token long term, that's completely broken.
One source described it as designed for extraction, not value creation. That sounds pretty damning.
It is, and it captures the core problem perfectly. Let's go back to that main use case. Winning the prize pool in an act.
Right, the game.
It's a one-time achievement per act.
Mm-hmm.
Someone like P0.eth, who won Act 1 back in November 2024, they exploited the AI, got the prize, and boom. For everyone else, the main incentive just vanished overnight.
The game's over until the next one starts.
Exactly. And beyond that temporary game, what else can you do with FAI?
That's the question. What utility does it have?
Very little, bordering on none. FAI holders don't earn any yield, like staking rewards. They don't get any governance rights. They can't vote on how the project uses its treasury, for example. And they don't get a share of any protocol revenue.
So no yield, no governance, no revenue share.
Which makes it almost purely a speculative asset.
Yeah.
And when speculation dries up, which it does spectacularly between acts, there's absolutely no fundamental value proposition to provide any kind of price floor. It's just air.
Okay, let's get into the root causes then. Why does it have no floor? Why does it keep falling? The sources seem to point to several major failures in the design.
Yeah, there are a few big ones. Let's break them down. Failure number 1, massive supply and zero deflation.
Okay, supply. How big are we talking?
We're talking a total supply of 8.189 billion FAI tokens. 8.189 billion.
Billion with a B. Wow.
And critically, it's all currently circulating. There's no vesting schedule, no gradual release. It's all out there, creating this enormous potential selling pressure.
So any spike in demand has to fight against this mountain of existing tokens that could be sold at any moment.
Precisely. And compounding that is the fact that there's no burn mechanism.
Nothing to reduce that supply over time.
Nothing. Successful DeFi projects often use a portion of their fees to buy back their own token and burn it permanently, remove it from circulation. This creates scarcity. FAI has none of that. The supply is static at best.
But wait, you said static at best. Does it actually increase?
It can. Yes, there's actually an inflationary pressure built into the periods of activity.
How does that work?
During the acts, users pay message fees to interact with the AI. Part of those fees I think it's 15%, according to one source, gets converted into new FAI tokens, which are then given out as rewards to participants.
So the very act of playing the game creates more tokens.
Exactly.
Yeah.
It's a low-level but perpetual inflation during the only periods the token actually sees demand.
Yeah.
There's no matching mechanism to destroy supply, so the total amount just keeps creeping up whenever the game is active. It's not a great setup.
No kidding. Okay, that leads directly into failure number 2, revenue misallocation. Where do those message fees actually go, if not to burning tokens?
Right, this ties back to that design for extraction idea. The revenue stream doesn't benefit the token holders at all.
So the breakdown.
70% of the fees go into the prize pool for that act.
The big one-time payout.
Yep, and the other 30%. That goes directly to the developers, the Eternus AI team.
Ah, so user activity funds the prize and pays the developers, but the token itself, the thing people are investing in, it gets nothing.
Correct. The revenue generated is completely disconnected from the token's value proposition. That 30% developer cut isn't used for buybacks, it's not distributed to holders as yield, it just goes to the team.
If other big DeFi projects did that, their tokens would be worthless too, wouldn't they?
Absolutely. Imagine if Uniswap or MakerDAO just kept all the fees. Their tokens rely on fee sharing or governance value. FAI's structure basically confirms that capital flows out to fund the game's spectacle and the team leaving the token holders to absorb all the downside risk and the dilution.
Okay, structural failure number 3.
Failure 3, the unproven long-term vision. Look, if a token has weak utility now, it needs a really compelling story about the future to justify its price, right?
Sure, you're buying the potential.
The team's big vision was always about moving beyond this simple game. They talked about creating a sovereign agent framework, a platform for developers to build and deploy their own AI agents using Freysa tech.
Okay, that sounds potentially valuable, like foundational tech.
Potentially, yes. But the key word is potentially. The execution risk here turned out to be huge. Because as of now, November 2025, over a year after launch, that framework is still completely theoretical.
It doesn't exist yet.
Apparently not in any usable form. One intelligence report we saw from Delphi specifically notes, FAI seems stuck in phase 1. They nailed the novelty game, but they haven't delivered on the promised transition to phase 2, the actual infrastructure layer.
And the market notices that kind of delay.
Oh, absolutely.
Yeah.
If you launch with huge hype and a big valuation based on delivering groundbreaking tech, and a year later all you have is the same game, investor confidence just tanks. People start thinking maybe phase 2 is never coming.
The conviction just erodes.
Completely. Especially when, as we'll see later, the valuation was still quite high on paper. You can't maintain that on promises forever.
All right, and there's a fourth factor, more external.
Yeah, we should acknowledge failure 4, broader macro sector weakness. FAI's collapse happened in a tough environment.
So it wasn't entirely its own fault.
Well, its internal flaws were definitely the main driver, the reason it fell so hard and consistently. But it's true that the whole Web3 AI agent sector took a beating around the same time.
What happened there?
A lot of similar projects saw huge drawdowns, 80–90% in some cases. Analysts point to things like waning Q4 DAI euphoria, basically. The initial hype around decentralized AI cooled off, plus general macro uncertainty in the markets.
So the tide was going out for everyone in that space.
It was, but FAI, because of its specific internal weaknesses, the massive supply, the lack of utility, the revenue extraction, it just had no ability to swim against that tide. It sank much faster and deeper than others might have.
Okay, so putting those 4 together, massive supply, no burns, revenue going elsewhere, and a failure to deliver on the future vision, all happening during a sector downturn.
It's just a recipe for the kind of chart we've seen, a relentless grind downwards with no real support.
Right, let's shift gears a bit now from the cold mechanics of price and tokenomics to the human element, the community.
Yeah.
What's the sentiment like?
In a word, fear. Extreme fear, actually.
Can we quantify that?
Yeah, the sources give us some numbers. The Fear and Greed Index, specifically for FAI, was recently clocked at 21.
21. What does that typically mean?
That's firmly in the extreme fear category. In market psychology, a reading that low usually signals widespread capitulation. People aren't just selling because they think it might go lower. They're selling because they're convinced it will go lower, maybe even to zero. They just want out at any price.
So panic selling, essentially.
Pretty much. And the technical indicators back this up. Sentiment is just overwhelmingly bearish. One metric showed FAI had only 9 green days out of the last 30.
Wow, so it closed higher on only 9 days and a whole month.
Yeah, that's a 30% win rate. It basically tells you that statistically, holding FAI recently has been a losing proposition most days. That feeds the fear cycle, you know? Why hold on if it only seems to go down?
And what about trust? Trust in the team, in the project itself.
That seems severely eroded, too. A major factor here is the anonymity of the core team, aside from the founder.
We know the founder, Shrikar Varadaraj, right, from Spectral.
Yes, his identity is known. But the rest of the Eternus AI team operating Freysa are largely anonymous. And that becomes a huge issue when they're managing a significant amount of money.
How much are we talking about?
The Treasury holds roughly $30 million raised from the community.
$30 million. And the anonymous team controls that while the token price collapses, and they haven't used it for buybacks.
Correct. You can see how that breeds suspicion and erodes trust, right? Holders see this pile of cash sitting there, doing nothing to support the price, controlled by people they don't know. It creates this really negative feedback loop.
Yeah, that sounds incredibly frustrating for holders. Did any analysts comment on this structure?
Yes, one institutional analyst was quoted raising concerns about the project's valuation, specifically the fully diluted value, FDV. They said a $260 million FDV feels pretty rich for a project at this stage, especially given the team's anonymity and the lack of progress on the core framework.
Okay, unpack FDV for us quickly. Why is a $260 FDV a concern here?
FDV is the theoretical market cap if all possible tokens were circulating right now. FAI has a huge total supply, remember, 8.189 billion. So even at a low price per token, the FDV is massive.
And that signals.
It signals to investors that there's a huge potential overhang of future supply. Even if the price recovers a bit, the FDV suggests the market is valuing the potential future product incredibly highly. When that product isn't materializing, and the team is anonymous managing $30 AS, that $260 FDV feels unjustified. Rich, as the analyst said. It fuels fears of further dilution and price drops.
So the valuation itself becomes a source of fear.
Exactly. And you see this reflected in community discussions, too. People start comparing FAI to other projects that, promised the moon but never delivered. That kind of association is toxic for confidence.
And were there any other red flags, maybe on-chain?
Yes, actually. Some on-chain analysis highlighted really suspicious activity. Random, massive spikes in the number of new buyers on certain days.
Oh, massive.
Like 10,000 to 33,000 new buyers appearing on specific days, out of the blue, and then vanishing just as quickly. The volume wasn't sustained.
That doesn't sound organic at all.
No, it screams bot activity, not genuine users discovering the project.
Why would bots be doing that?
A couple of possibilities. Maybe trying to farm the rewards during the acts, or, more cynically, potentially wash trading, creating fake volume to make the token look more active, maintain exchange listings, or lure in real retail buyers who see the volume and think something positive is happening.
The impact of that.
It just destroys trust further.
Yeah.
If the community suspects the volumes and user numbers are being faked, they lose faith in all the project's metrics. It reinforces the idea that the whole thing is unsustainable, propped up by temporary games and maybe even manipulation. Once the game stops, the fake volume stops, and the price continues its inevitable slide.
Okay. This brings us squarely to the listener's core question. Is the team responsible for this price decline? It sounds like they didn't hack it, they didn't outright steal the money.
Right. It's more nuanced than that.
But did their decisions, or lack of decisions, lead to this 93% drop?
Based on everything we've seen in the sources, the verdict is, yes, the team bears significant responsibility, but it's primarily due to strategic failure in inaction, not, outright criminal behavior like a classic rug pull.
So, not malicious, but incompetent or misguided.
Perhaps. They built a project that worked technically, the game was initially engaging, but they fundamentally failed to create a sustainable token economy around it. The collapse is the market realizing the emperor had no clothes, economically speaking.
Let's list those key strategic failures again, the things that directly contributed to the price falling and staying down.
Okay, first, a massive one, no buyback program. They're sitting on $30 million in community funds, yet made no effort to use that capital to support the token price during the crash.
Which sends a terrible signal, right? Like they don't believe in it themselves.
Exactly. Using Treasury for buybacks is a standard way to signal confidence and provide some price stability. Their inaction basically abandoned the token to its flawed mechanics.
Second failure.
No governance mechanism. Token holders have zero say. They can't vote on Treasury use, strategic direction, nothing. They are purely passive, speculative holders with no control over their investment's fate. That alienates your community.
Makes sense. Third.
The big one we discussed. Lack of execution on the sovereign agent framework. That was the long-term value prop, the reason to hold beyond the game. Over a year later, it's still vaporware. You just can't sustain a valuation on a promise that never arrives.
And the fourth ties it all together.
Yeah, the fundamental strategic mistake, relying entirely on cyclical gameplay as the only demand driver. They built a hit novelty game, but failed to build anything durable underneath it. No persistent utility, no real AI infrastructure that people would use day to day. They created a mayfly, not an ecosystem.
Just putting it all together, the 93% drop isn't a mystery?
Not really. It's the market waking up to the fact that they brought into a temporary hype cycle, fueled by a novel game, but attached to a token with fundamentally broken economics and an unproven delayed long-term vision.
Once the novelty wore off, there was just nothing left to hold the price up.
Exactly. The tokenomics provided no floor, no inherent demand. The price is just reflecting the reality that the primary use case was ephemeral.
Okay, let's wrap up this deep dive. Key takeaways for you, the listener. We looked into the Freysa FAI token's 93% collapse.
And we found the smart contract code itself is actually solid. No technical exploit here.
But the problem lies deep in the economic design. The tokenomics seem almost designed against the token holder. Massive supply, no burns, revenue flowing elsewhere.
Coupled with a failure to deliver on the long-term vision, leaving only temporary game hype to drive demand.
Which led to a community sentiment of extreme fear, potential on-chain manipulation, and ultimately this catastrophic price decline.
And it really highlights a critical point.
Yeah.
Technical soundness isn't enough. A secure contract can still fail spectacularly if the economic incentives and long-term strategy are flawed. FAI is unfortunately a powerful case study in that.
Definitely a lesson there about looking beyond the hype and digging into the actual mechanics and utility. So, our final provocative thought for you to chew on. We know the founder, Shrikar Varadaraj, has a public profile, but the rest of the team managing Freysa and that $30 million treasury remain anonymous. Given this outcome, it raises a big question. What's the right balance between team anonymity, which is common in parts of crypto, and the need for investor confidence and accountability, especially when you're managing tens of millions in community funds and your valuation relies entirely on delivering a complex future product?
Yeah, how much transparency is actually owed in that situation? When does anonymity stop being about privacy or security and start becoming a shield for lack of progress or accountability?
Something to think about as you evaluate other projects in the space. That's all the time we have for this deep dive. Thanks for joining us.
Catch you next time.